Welcome back to the Daybreak Asia Podcast. I'm Doug Krisner. So the U.S. equity market sold off today as those U.S. Treasury yields jumped. The message from the bond market seemed to be, get your fiscal house in order. We had the S&P closing down 1.6% today for its sharpest slide in a month. Joining me now is Rebecca Walser. She is president at Walser Wealth Management. She's on the line today from Phoenix, Arizona. Can I begin by asking for your assessment on what we saw in today's market price action?
Yeah. Well, Doug, it's what we've been talking about really for the last 6 months. This global macroeconomic change that is really being spurred here by debt spend and growth of debt by central governments, really for the last I'd say 15, 20 years, but since coronavirus in 2020, it has been exponential. So we started off expecting this week to be a little bit turbulent in the equity space because of the downgrade on Friday on Moody's to align with all of the other rating agencies. But we expected that was going to create some turbulence. But now what we're seeing is that global impact. If you look at the 20-year sale yesterday in Japan, that went really poorly. And that was a big tell for Japan. And now today, Wednesday, we see similarly, and obviously 20 years is never the same as the 30 or the 10, but it's still a tell, right? And anytime we start to see sluggishness and us selling our debt, that has got to be a wake-up call. And so obviously the equity markets did not like that. We are looking at a global slowdown, and obviously the tariff policy is on top of that. We've been talking about this slowdown before Trump came in, before Trump started talking tariffs. So this has been happening. Then he's got his policy on top of that. And then when you see that, the global demand, this is not just a United States problem. This is China has issues and is collapsing from the property side. Japan has issues and is collapsing from their debt financing. Their debt financing is way beyond ours. As you know, they are the highest leveraged country in the world. So, we have all of these things that are pointing us to just real systemic underlying foundational issues that are not just going to get worked out around by micro quarterly expectations of Fortune 100 companies to do well.
The yield on the 10-year just under 460 today. I think we've picked up, if you just look at the 10-year alone since the Fed pivot, around 90 basis points. That's a monster-sized move. How much higher do you think the 10-year yield can go from here?
Well, I think that if we continue to see more, what's happening is things that are being priced in right now is just too much risk. If you look at that Moody's, press release for why our debt, they finally, followed all of the other rating agencies and gave us a downgrade. It's simply a matter of the inability to sustain our interest payments. We can't have our interest payments be 30% plus of our budget in the next 10 years or the next 5 years. And what happens when you have an administration like the Trump administration, not saying pro or against, but his package is multi-trillions of dollars, just as Biden's budget was a $7.2 trillion budget. When you're collecting $5 trillion in taxes, and your budgets are in the $7 trillion range, which you're debt financing $2 trillion, but you're not just debt financing $2 trillion, Doug. You're debt financing all of the interest on the I'm going to round it up, $38 trillion that we've already not collected in tax revenue that we've spent. And so, we used to say this is our grandchildren's problem. And then when you say it's our children's problem, this is actually our problem. The people that are alive today are going to be dealing with this problem in less than 10 years. This is a global macroeconomic catastrophe that is not going to be mathematically avoided at this point.
So if you see the risk of a yield on the 10-year pushing above, let's say we get to 475 on the 10-year, that would be another 15 basis points from here. It doesn't seem like a lot. Do you avoid the longer end of the curve right now? And if you had to put money to work in the bond market, stay on the short side?
Yeah, I think you have to. And let me tell you why. Because this is a self-fulfilling prophecy at a certain point. You have to understand that this is all interconnected. And even though the bond world really finances the world, we know that. We do also know that Wall Street is the one buying the bonds eventually. And if Wall Street isn't seeing that they can invest, they can't buy low and invest into their companies and make profits and sell, make the differential, then they're not going to be doing that. And the fact is that when you have yields that are that high and you have deficits that are this high, and you're going to be doing nothing but deficit financing for the foreseeable future. I mean, we have economists that have basically said we will never be able to pay our debt. It will never happen. And so we are globally entering kind of a debt spiral of just too much debt with too little income and too little revenue to sustain it. You can't have a 4%, net deficit, trade deficit, when you're only growing your economy by 2.4% or 2.3% a year. You're literally losing GDP as you speak. You're literally contracting the entire economy.
So President Trump seems to be intent on getting his giant tax bill pushed through. The Joint Committee on Taxation is estimating this bill would increase the deficit by $3.8 trillion over a decade. To your point, what does this mean for the equity market? And if you had to put money to work in stocks right now for clients, how would you go about doing that?
Well, it comes back down to what we've been talking about for 6 months, Doug. When we're getting to a point where there is a global macroeconomic problem with your currency, with the M2 money supply, with what is happening with liquidity. Because remember, we've got all these commercial banks that now have unrealized equity losses since the tariffs went into place. And they have all kinds of unrealized property losses that they haven't wanted to realize yet because the property valuations of our commercial lenders, obviously the commercials have gone down. So when you're looking at that, you have to think commodities. You have to think, what are the safety assets for if we have some kind of collapse? You've got to have some kind of allocation to safety, and that's real assets, hard asset classes, real estate, gold, silver, commodities, energy, utilities. Beyond that, because we have to have all of that to live, beyond that, you have to then say, okay, on a certain portion of your portfolio, we want growth. So we're looking at AI, robotics, quantum computing. But you can't look at that if you have to have immediate returns, because this is in the monetization phase. It has not yet monetized. It's going to take a while to monetize. So we want a mix. But I will tell you, these global changes that are happening right now are definitely make us be more macro resistant and a little bit more cautious and a little bit more going towards the things that we know are going to perform. If we do have, just Japan yesterday, and then the United States today, both on their 20-year auctions, this looks really bad, Doug. And this is on the heels of another credit downgrade that we've had in our country. So I just think that Trump has got a really hard time dealing with all of this and still trying to pass a multi-trillion-dollar budget and package. And we can't have the SALT limit at 40,000, which is what is being held up now by the Republicans. How can you authorize 40,000 as a SALT limit when 10,000 was scored to give us, multi-trillions of dollars of deficit? We just don't have the money. And we're starting to see that the rest of the world isn't going to buy it for us, isn't going to provide it for us.
So you seem to be saying that it's not just a U.S. issue when it comes to the risks of equity markets. It's global. I'm getting that clearly, right? But
absolutely,
it's something that I think we have to look at in terms of Sell America. Is that still a predominant theme that maybe you want to look at markets like Europe? Maybe there are selective markets in Asia, that the theme of Sell America is still something that you want to kind of stay true to?
If you look at the institutionals, the hedge funds, everything, they were still very pro-Europe and anti-America, and we're still net selling out in April. So I think that there are still a lot of groups that are like that. Will you be able to find a country that does and outperforms America in 2025? Yes. But will that country have the economic security that we have here in the United States as the world's reserve currency? No. But is our security as the world reserve currency what it's always been? And can we just relax on that and go to bed at night and not have any cares? That's a no now, too. So everything is changing almost all together at the same time, Doug. And this is what you get when you start to approach a debt spiral. This is exactly the beginning stages of a debt spiral. The interest becomes too much of a portion of your budget, and therefore you cannot keep expanding and expanding and expanding your spending. It just has to end at some point.
So, Rebecca, in your model portfolio right now, talk to me about the level of cash or cash equivalents. As high as 30% at the moment?
Well, we do like to go, we don't like to have a lot of auto cash for too long. So we will go to strong hard asset before we stick 30% in cash. But I would like to see an allocation of cash anywhere from 10 to 15 right now, because this is just a very rapidly changing environment. And you can see that, we've had 5 consecutive months of University of Michigan coming in with negative sentiment. And the consumers aren't, thinking that they're going to be able to go out and buy once the tariffs hit. We only have a 90-day pause on tariffs. So I would say right now we're at 10 and 15, between 10 and 15%. And the difference between that and 30 would be what we'd allocate to hard assets.
It's always a pleasure to talk with you. Thank you, Rebecca. Rebecca Walser there, president of Walser Wealth Management here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.